This is Ethan, CFA Charterholder and investment professional, and today I'll be reviewing COWZ, the Pacer U.S. Cash Cows 100 ETF, and showing how it stacks up against common dividend ETFs like SCHD and broader U.S. equity ETFs like VOO. Let's dive in. COWZ gained tremendous popularity over the last few years, growing from under $1 billion of assets in 2021 to more than $25 billion today, making it now more than half of Pacer's entire firm's assets. So why do people like it so much? Well, the short answer is that it's nearly kept pace with the S&P 500 without having to rely on extreme concentration in the Magnificent Seven stocks and big tech. More specifically, over the last 5 years, COWZ is actually ahead of VOO. Unfortunately, there's still pretty strong evidence that most COWZ investors have actually done much worse than this, but we'll save that for the end. First, let's dive into how COWZ works and how it compares to dividend ETFs like SCHD and broad U.S. stock market ETFs like VOO. COWZ is pretty simple. It invests in the top 100 companies in the Russell 1000, which is a similar index to the S&P 500, but with 1,000 companies instead of 500, based on free cash flow yield. The goal is to find high-quality U.S. companies at attractive valuations. We'll dive more into specifics in a moment, but first, let's cover the basics. To understand an ETF based on free cash flow yield, you first need to understand what that is. And in order to do that, you need to understand free cash flow. So let's start there. By the way, I've heard some crazy wrong explanations of how this ETF works in other YouTube videos, so I'll be sure to set the record straight on those too. Pacer defines free cash flow as cash flow from operations minus capital expenditures. Essentially, that means it's the cash left over for a company to do whatever they want with after they pay for their essential expenses like taxes, interest on their debt, inventory, and equipment purchases that they can't really avoid if they want to remain a viable business. Free cash flow is broadly considered to be the best metric to value companies on, except for banks. It doesn't really work for banks. But other than that, it's generally considered to be better than earnings, better than sales, better than book value, in part because it can't be as easily manipulated by the company as some of those other metrics. There are actually multiple different kinds of free cash flow, but I'm going to try to keep this as simple as possible. So ask me about that in the comments if you're interested. The free cash flow yield is the free cash flow over the enterprise value. So to understand that, we also need to understand enterprise value. Enterprise value, you can see Pacer's definition up at the top if you want, but I think there's an easier way to understand it. Enterprise value is commonly used to value private companies because it's meant to measure the price that another company would have to pay to acquire that company. It starts with the current market value of its common stock, preferred stock, and debt. Yes, debt, because if a company were to want to acquire another company, they wouldn't just have to buy out its equity holders, aka its current owners, but they'd also have to take on its debt. Cash is subtracted from enterprise value because the acquiring company would receive it, which would effectively lower the net cost of the acquisition. This is an unusual way to calculate free cash flow yield. Normally, for public companies, it's done using stock price instead of enterprise value. Or, if it is done using enterprise value, it's done using a different measure of free cash flow yield that doesn't subtract the interest payments to debt holders. This combination is weird, but I digress. So basically, what this version of free cash flow yield is measuring is the cash the firm is generating from its operations that can be used to do whatever it wants, divided by an alternative measure of the firm's value, called enterprise value. But in the end, the yield figure, while not representative of an actual payout, is a way to measure what percentage of their company's value they could theoretically pay out in yield. So when comparing COWZ to something like SCHD, that is a key difference. SCHD is focused on the yields companies are actually paying out. COWZ is focusing on the yield they could pay out. Now that you understand the basics of free cash flow and free cash flow yield, let's go a bit deeper into how COWZ is constructed, and then we'll dive into how it's done in different market environments and how it compares with VOO and SCHD. Starting on the upper left, you can see they start with the Russell 1000, which I mentioned earlier is a fairly similar market cap weighted U.S. stock index to the S&P 500, just with 1,000 companies instead of 500, meaning almost the exact same holdings as the S&P 500, but slightly smaller percentages in the largest companies and tiny bits of 500 smaller companies that aren't in the S&P. From that index, they remove financials and screen out companies with negative projected free cash flow yield or earnings over the next 1 and 2 years. These are just based on generic third-party analyst estimates from FactSet, not their own research. Then, they take the remaining companies and pick out the 100 with the highest free cash flow yields. Those are the 100 companies that are included in the ETF. But they're not weighted based on free cash flow yield. They're weighted on just free cash flow over the past 12 months. So within that subset of highest free cash flow yielders, there's a general bias to the bigger companies. But a lot of the biggest companies in the index overall don't have a high enough free cash flow yield to make it into the portfolio in the first place. So that ends up becoming a very key differentiator versus a fund like VOO that just invests the most in the largest companies regardless of valuation. After COWZ has its 100 companies selected and it has its weights, it then puts a cap of 2% per company. So it holds less of the largest companies and more of the smaller companies than it otherwise would. You end up with the top 100 U.S. companies with the highest free cash flow yield, weighted by the trailing 12-month free cash flow, with holdings capped at 2%. And the portfolio is reconstituted and rebalanced quarterly, meaning each quarter they run these screens again and then sell what they need to sell and buy what they need to buy to get in line with the new portfolio that the computers are telling them to buy. So that brings us to the first misconception about COWZ that I've heard out there on YouTube, that it's somehow better than other passive ETFs because it uses forward-looking projections. No, not really. It eliminates companies based on third-party earnings and cash flow projections, but only if they're negative. And then the way that it chooses the companies that it actually owns is by using the highest free cash flow yield and free cash flow over the trailing 12 months. And there's very little chance that one of the companies with the highest free cash flow yields would be projected to have negative earnings or a negative free cash flow yield over the next year. So I actually doubt that that forward-looking screen ever has much of an impact on the portfolio. The next misconceptions come with what's been driving results. So let's take a look at how COWZ is done in different market environments and bring in SCHD and VOO for some comparisons. First, let's focus on a week period from late 2018 through 2019. The explanation I heard for this was that the Fed was lowering interest rates and high free cash flow yielding companies don't benefit from that as much because interest expense reduces free cash flow, and therefore companies with high free cash flow yields must not have a lot of debt. I can see the logic, but it's way off. The Fed cut interest rates a little bit from July to November of 2019, but COWZ started trailing VOO and SCHD before that and continued trailing them after that. Plus, it just makes no sense, but we'll get to that in a minute. It trailed in that time because the market was led by big growth companies, not small value-oriented companies, which is what COWZ owns a lot of. That's Schwab U.S. Large Cap Growth in purple and Vanguard Small Cap Value in light blue. Companies like Microsoft and Apple were rallying and driving the market. That's not an environment where you would expect COWZ to do well in, but those kinds of environments usually don't last. So this shouldn't have been a reason to worry. Then we have the period of 2022 when rates were rising, and the same explanation was given. Companies with high free cash flow don't have a lot of debt, so they weren't impacted by interest rates. No. You see, companies don't borrow money on like a 1-month basis. They take out loans in terms of years, 3 years, 5 years, or sometimes longer. So interest expenses are only now in 2025 and 2026 projected to really start biting companies as they have to refinance those loans. It didn't happen immediately. That's one of the main reasons we did not end up having a recession even when the Fed raised rates so much, because companies weren't actually feeling it yet. The reason COWZ did so much better in this environment was because value did so much better. And unlike the 2018 and 2019 period, it had a fraction as much tech as the S&P and multiple times more energy, at times over a third of its portfolio in energy and less than 5% in tech. Well, energy dominated the market because first it was recovering from when oil prices went below zero in 2020, and then they spiked even higher in 2022 when Russia invaded Ukraine. That's Vanguard Energy in light blue. At the same time, high interest rates hurt tech companies. That's Vanguard Tech in purple. Not because tech companies don't generate a ton of free cash flow and they're heavily reliant on debt. That's not even remotely true. It's because they're growth companies and their future earnings are worth less in today's dollars when interest rates are higher. So here's how I would think about the role COWZ can play in a portfolio. In my opinion, getting our heads around how COWZ will do in any given environment is not as easy as it is with most other funds, because its formula for picking stocks can make its exposure jump around like crazy. This is its historical energy exposure over the last 4 years. COWZ is in blue, with SCHD in green and VOO in red. COWZ had literally 0% energy exposure at the end of 2020. Then, by early 2023, it was over 35% of the portfolio, then cut in half over the next year. SCHD is not likely to ever get to those extremes, and it should pretty reliably have more energy and other value-oriented sectors than the S&P, except maybe in very extreme energy crises like we had coming out of 2020, where oil went to zero and energy companies couldn't pay dividends. VOO will probably be the most stable. This goes for all sectors. I'm just using energy as an example here. COWZ also had over 20% tech in 2020, then between 5 and 9% for about 2 years starting in March 2022, then back up to 19% in June 2024. It's rules-based, so they're not making decisions. They just go where the computer tells them to go. Another way to visualize this is through the factor profiles. The light blue shaded area is where each factor or characteristic of the funds have been over the last 5 years, and the blue circle is where they are currently. This can give us a sense of how exposure has moved around over time and whether what we see today is what we can expect in the future. On the left, you can see COWZ has been consistently value-oriented, consistently invested in dividend payers, and consistently small cap. It's also been highly liquid, meaning the companies it owns were easy to trade in and out of, but I think our main focus should be on the other three. So consistently small cap, value, and focused on dividend payers. Compare that to SCHD in the middle, that's also consistently value and focused on dividend payers, but generally not so focused on small cap companies. Then VOO on the right is consistently in the middle on pretty much everything, except its obvious bias towards large caps since it's a market-weighted index fund. For COWZ, other things like momentum, quality, and to a lesser extent volatility have fluctuated around quite a bit. So the main lesson here that we should take is that it should be consistently small cap, value-oriented, and invested in a lot of dividend-paying companies, which means it will behave very differently than the S&P 500 in pretty much any market environment. In my opinion, that makes it a good complement to VOO, and it can also be used as a replacement for VOO, but if it is, I think it is crucial to think long-term and go in with an understanding that it will likely behave very differently, good and bad, from different market environments. We saw earlier that it can produce competitive results to VOO, even over the last 5 years when VOO has done really well. But did investors really capture that return? I don't think they did. Here's why it's so important to really understand how an ETF works and think long-term, so you don't fall into this trap of buying high and selling low. In the chart at the bottom, you can see the fund's inflows mainly came in after the good returns in COWZ as investors chased results. COWZ did really well in 2021, but investors didn't really start buying in until the end of the year and in 2022. 2022 was a good year, but then the S&P 500 started to really come back strongly against COWZ. Actually, it was going up while COWZ was going down in early 2023. And all those investors who had just bought in, that was their first experience. That's what they felt. Then, a lot of them sold right at the bottom, right before COWZ recovered. After the recovery, then they started buying in again in late 2023. COWZ had a terrible 2024 compared to the S&P 500. Actually, if we just zoom in on the last year, look where most people were buying. Right at the top when COWZ was beating VOO by a lot in March 2024. Then it proceeded to absolutely get crushed by VOO the rest of the year. And now investors are selling out of COWZ again. So does that mean this is a buying opportunity? Well, yes, I actually think the setup for COWZ is pretty strong from here, but there are actually 2 less well-known free cash flow ETFs that I think could be even better alternatives, and I'll be comparing COWZ to those in our next video. So hit that subscribe button if you want to be notified when it comes out. And if you'd like to connect with my partner Kyle and I directly, you can do so by joining our Discord through the link in the description.